All right, let's talk about investing. We're going to cut through the noise and break down the huge ideas that really drive the modern financial world. In just the next few minutes, you'll get the core principles that every single investor really ought to know. Okay, let's just dive right in with a little thought experiment. Picture this. The stock market just tanks. It's down 30%. You've got 10 grand of your own money in there. What's your gut reaction? Do you hit the panic button and sell everything? Do you just do nothing? Or do you actually see this as a chance to buy more? Seriously, what would you do? Your answer says a lot about how you think about the single most important idea in all of investing: risk. So just hang on to your answer for a minute. And this leads us right to the first big problem every investor has to solve. We'll call it the problem of choice. Because at its core, investing is all about one fundamental trade-off. And you can see it right here in the data. I mean, look at this. If you go all the way back to 1927, US stocks have returned, on average, over 12% a year. Now compare that to super safe US Treasury bills, just over 3%. That huge difference isn't some kind of fluke. It's literally the market paying you for being willing to stomach more risk. So here's the takeaway. There is no free lunch. It's as simple as that. If you want a shot at those big returns, you have to accept bigger risks. Stocks can have amazing years, up 55%, but they can also have absolutely gut-wrenching years dropping by almost half. On the flip side, Treasury bills, they're basically as safe as it gets, but you're just not going to see that explosive growth. So if taking on risk is the only way to get returns, how in the world do you protect yourself from getting completely wiped out? Well, finance has a really powerful answer for that. It's all about taming that risk through something called diversification. You've heard this a million times. Don't put all your eggs in one basket. Well, that's literally all diversification is. By spreading your money across a bunch of different investments, you're making sure that if one company has a total disaster of a year, it doesn't sink your whole ship. And this part is key. Its whole purpose is to get rid of firm-specific risk, the danger of one single company going under. That's what helps you sleep at night. Just to put some numbers on it, how risky is it to bet on just one stock? Well, if you measure risk by something called standard deviation, which is basically just a fancy way of saying how bumpy the ride is, the average is a staggering 27.8%. That is a wild, wild ride. But now, watch what happens. If you take that same amount of money and spread it across just 30 different stocks, that volatility, that bumpiness plummets down to 17.4%. You just smoothed out your ride and got rid of a huge chunk of risk, and you did it without lowering your expected return. That, right there, is the magic of diversification. Okay, so you've diversified, you're protected from any one company failing. Awesome. But what about the risk you can't get rid of? The risk that the entire market takes a nosedive. That brings us to our next problem. How do you figure out what a fair price is for that kind of risk? Well, the answer comes down to this little Greek letter, beta. The easiest way to think about beta is as a kind of volatility score. The entire market gets a score of 1.0. So a stock with a beta of 1.2 is, in theory, 20% more volatile than the market. And a stock with a beta of 0.8 is 20% less volatile. It's just a measure of how sensitive a stock is to the big swings of the overall market. And here's the crucial point, which comes from a famous theory called the capital asset pricing model. It says the market only rewards you for taking on that big market-wide risk, the risk that beta measures. It doesn't give you any extra return just for owning a single risky stock, because hey, you could have gotten rid of that risk for free just by diversifying. You see where this is going, right? It all leads to one of the biggest, most intense debates in all of finance. If prices are already set fairly based on risk, can anyone actually consistently outsmart everybody else? This whole debate is at the heart of what's called the efficient market hypothesis. It's a pretty radical idea. It basically argues that a stock's price already reflects all the public information out there. And if that's true, well, then trying to find a hidden gem or a bargain stock is a total waste of time. The price is already right. So this debate basically creates a fork in the road for investors. On one side, you have active management. This is the world of trying to find those mispriced stocks, trying to time the market perfectly. And on the other side, you've got passive management. This approach says, you know what? I think the market is pretty efficient. So I'm just going to buy a piece of everything, like an S&P 500 index fund, and just hold on for the ride. But look, investing isn't always about just buying the whole market and hoping for the best.
What if you have a really specific goal? What if you need to protect against a very particular risk? For that, you need some more advanced tools from the Modern Investor's Toolkit.
So let's just touch on two of the big ones, options and futures. The difference between them is actually pretty simple, but it's so important. An option gives you the right to do something, but you're not forced to do it. A futures contract, though, obligates you. You have to follow through. It's really the difference between having a choice and having a firm commitment. So why does any of this matter? Because these kinds of specialized tools let investors get way more precise than just buying or selling a stock. You can use them to hedge, to protect yourself against a very specific risk, or to make these incredibly targeted bets. It's like going from a sledgehammer to a scalpel. It's all about precision. And that brings us right back to where we started. We've gone from the simple risk and return trade-off all the way to the complex tools for managing it. And it leaves us with the ultimate question that still divides Wall Street. Is the market some kind of perfect logical machine? Or, at the end of the day, is it just driven by us, by human psychology, by fear, and by greed? The search for that answer is what makes investing so incredibly fascinating. Thanks for tuning in.